OpenAI acquired personal finance startup Hiro Finance on Monday, marking its second fintech purchase in 6 months following the October 2025 acquisition of Roy. What's up, everybody? Welcome to another edition of the Free Toaster podcast. I'm here with Free Toaster co-founder Nick Madrid. I am Carlos Caro. On this pod, we break down one story from the news edition, which we publish on Wednesday. If you're not currently on that edition, come check us out at thefreetoaster.com. We publish stories exclusively at the intersection of consumer lending, marketing, and technology. This one definitely passes the test for all three of those. Nick, we're definitely in the technology lane here with OpenAI. Before I kick it to you, I want to thank our sponsors, Bulldog Media Group, Spinwheel, and Fintel Connect. Nick, what have you found about Hiro Finance?
Yeah, thanks, Carlos. This is super interesting. So if you all don't know about the Wayback Machine, it's phenomenal. I can go back and see old websites. And so I really went deep in Hiro and deep in Roy. Again, I couldn't quickly verify the pronunciation. So it is what it is. That's what we're calling it.
We're going to go with Roy then.
So Hiro was essentially built to be an AI personal CFO. The founders are experienced. They previously built and sold the financial platform Digit, if you don't know, for almost 250 million. And the goal of Hiro was to use advanced AI to improve the overall financial well-being. And before being recently closed, Hiro managed over $1 billion in client assets. So there was some traction there, which I think is important. It stood out by being an AI financial planner that used, quote, verifiable math. So you could ask it complex questions like whether you have too much cash sitting and checking, or if you want to test out life scenarios like changing jobs or having kids. It offered a comprehensive net worth and cash flow tracking. With Plaid, it linked to a bunch of financial institutions, integrated with Coinbase and Zillow and machine learning, an ML engine. So really powerful engine behind it. They had family collaboration features for sharing spaces for household finances and so forth. And so, on April 13th, which was the story that we included, the team announced that they were acquired by OpenAI. And then the app just stopped working altogether on April 20th, which I think is fascinating. So seemingly good traction, pretty well-known investors behind it, get acquired, and then they just stop. Let's unpack that a little bit later. The second one, which happened about 6, maybe 8 months ago, Roy was an all-in-one investing platform designed to help users track, trade, and grow their net worth from a single app. It created by a team of former employees from Airbnb, Google, Nike, and then that platform focused on centralizing your entire financial life, particularly brokerage, but also other asset types as well. What I thought was really interesting was their comprehensive asset tracking. So Roy tracked traditional public assets like stocks and ETFs, digital assets like crypto and NFTs, real estate, physical assets, watches, artwork, trading cards, shoes, wine, and vehicles. So for me, what I found fascinating is Roy is the ability to track the price of anything. In our world, what comes to mind, right? When we think about, the credit cards and loans, naturally that seems like a good fit. But to you, what's coming to mind?
Yeah, no, I mean, it's the first thing that stood out. I'll talk about Hiro, I guess, first. Although I think Roy kind of is interesting on that price discovery feature. It feels to me like a surface that you would want to invest in. And particularly around debt consolidation was one of the use case I read, Nick. So I'm imagining a customer in OpenAI saying, hey, I have these trade lines at these interest rates, and really having a deep conversation with the agent about this stuff. And it seems like they're setting up a business line where they're just really, really smart about personal finance. They can tap maybe credit bureau data. Maybe they can tap into Plaid. I don't know exactly. I haven't gotten into the guts of what Hiro built, but I assume it's going to be something super sophisticated that helps OpenAI have a really in-depth, accurate conversation about consumer finance. But I doubt they're going to stop at the information layer, because I don't think there's any money for them at the information layer. I don't think they're going to sell ads against that. To me, I start imagining a world where they're like, oh, wow, okay, I understand your debt so perfectly, and I know exactly who you are, and I know your credit profile, that I'm going to hit 100 banks, and I'm going to come back to you with the best offer that consolidates these loans. I can tell you to the penny how much money you're going to save. And if you want that, all you have to tell me is yes, and I'll just go do it. There's no forms. There's no consents. There's no anything. It's yes. And then the bot comes back and says, by the way, those debts are paid off. here's where you need to log in to pay your new lender, and I just saved you $300. That's a kick-ass business. I think drives the friction in, like consumer lending marketplaces down to like near zero. And if they can pull off that product experience, it would be like nothing else out there. So like that's what came to mind, Nick, as I was thinking through that is, damn, are they trying to build a product that's gonna, challenge the likes of Credit Karma?
Yeah, we talked about this in the prep call, and I had a few like follow up questions to help unpack
Yeah.
this. I think you have a strong point of view on this, which I hope that you can share it. Um, but when we think about the friction in today's financial system, is it generally designed to protect the consumer versus just um, how much is just terrible, outdated legacy banking software like really helping, making it more cumbersome? Like if OpenAI truly makes it zero friction, what does that mean to the consumer? What does that mean for lenders?
Yeah, no, I mean, I've actually, since our prep call, I've even had a chance to play with that a little bit, Nick. And the first thing that came to mind to me was like, there's I think some local conversations happening right now in my county because there's a casino that might be open nearby, and it's all the same conversations that happen when a casino might come to town, right? What's it going to do to the community, and is it going to attract the round crowd, and yada yada yada, right? So if you're prone to gambling too much, probably the last thing you want opening next door, a short walk away from your house, is a casino, right? Because all of a sudden the friction just went from, man, I have to drive an hour to get there, to I could walk across the street and go to the casino. So I think, um, and same analogy applies. If you're prone to drinking a little too much, you're never going to move to an apartment where like the bar down the street is like the most lively. You're gonna distance yourself, right? And if you're a customer that may be prone into getting over their skis with debt, you've had problems with debt, you don't manage your personal finances well. For that specific consumer, I think driving the friction down to zero is really dangerous, right? Because for that consumer, they don't necessarily know who's going to lend to them. They're often declined. Like there's built-in friction. And Nick, to your question earlier, I don't think it's by design. I think it's just kind of structural in the way the industry was built up till now. Um, so I think it's accidentally protecting some consumers today. I don't think it was designed that way, but I think it's accidentally protecting some consumers. So the question I asked myself is zero friction consumer lending like actually a good thing? And I feel pretty confident in saying I don't think it's unequivocally a good thing for everybody. I think it's great for me, maybe for you. Like as a business owner, I would love if there's a purchase order I know is coming and I could get liquidity by snapping my fingers in OpenAI and it shows up in our bank account. I would probably pay a little bit of money just to get the certainty and the speed. So there are contexts for me where frictionless lending would be incredible. I think there are contexts for a lot of people where it would be a really bad thing. So I guess that's my answer to your question is like, depending on who you are, I could see this opening up some dangerous territory.
Let me give you a quick point on this, and then I want to move on to the concept of underwriting this whole thing. But if AI removes the friction of getting a loan, like, is it safe to assume that it also removes the friction of the financial literacy component? Where like, could AI act as an advisor, saying, "I can get you this money, but it's going to cost you $400 in interest over 6 months. Like, are you really sure?" Like, perhaps it's a really good place to actually inject that financial literacy and almost kind of add those guardrails there. That otherwise isn't known or widely understood.
Yeah, no, I actually I love that actually, and I think a chatbot or when this evolves to voice, which I believe it will, like having a human with an empathetic tone, kind of walking you through the consequences of the choice you're about to. I could see that being really powerful. To me, there's kind of a pretty dramatic incentive problem though here, because if you're OpenAI or if you're any marketplace that monetizes on conversions going through, your incentive is for the conversion to go through. You have someone with intent, you've matched them to a bank, they want to do the thing. Now I'm struggling with like what framework do you put on actually slowing that person down intentionally and potentially actually talking them out of it. Even though the transaction friction is zero, you're saying, Nick, maybe there's some moral ground here to cover. that actually discourages a customer because it actually might be a bad thing, even though the bank would say yes, and even though it's frictionless. And I just have a hard time imagining an outcome, at least in the next few years, where an OpenAI builds something that's that thoughtful. Not to say it's impossible. I actually love the vision of what you just described. I just don't think the economic incentives surrounding it like kind of enable it today.
Let me give you another scenario. This is more in the doomsday, and I actually don't know what would happen. Okay, so I'm moving into the underwriting guidelines. So in theory, I think underwritings help kind of prevent some of these bad things from happening. But if my AI agent can instantly apply for 50 different bank loans simultaneously, and it gets a yes, how do banks protect themselves from this other side of the equation?
Yeah, it's a really interesting question, right? Because what if we run that at scale? Now everybody, instead of getting, if your baseline is 100,000 applications a month, and the scale distribution channel is something that where every consumer applies 50 times, now you're processing, let's say, 50x the decisions that you were before. So you're seeing a fundamentally different audience. The risk on that audience is different. Um, yeah, that's a. I don't think banks could adjust quickly to that overnight. It would take a lot of data to see, well, customers that come from this channel, how do they perform when I do approve them? And you would have to recalibrate everything: your line assignments, your interest rates, your yes nos. And I've talked to many lenders already over the years, Nick, that already have calibrated underwriting by channel. So they don't necessarily say the same thing whether you came from search or direct mail or karma. There's already some nuance to the channel based decision, but I think this would really drive that into like another place entirely. So I do think it's addressable, but probably takes years to recalibrate.
One of the things that came up in prep, and we also included in our newsletter yesterday. And so I want you to provide the context. I'll ask the question, but I want you to kind of take a step back and provide the context. So, Google basically failed at a financial distribution because of trust. But is OpenAI viewed differently? Like, this conversational AI companion fundamentally more trustworthy to like a Gen Z or Alpha than a traditional search engine?
Yeah, yeah. And let me set the context. Yeah, I'm glad you asked that one, Nick. I followed this one closely. This was probably, man, I'm gonna say 8 to 10 years ago, something like that, where a lot of folks in the industry that I worked in, and this was credit cards specifically, they were wondering why Google was selling clicks at call it $20, $30, something like that. They were selling clicks to like the nerd wallets of the world, the chases of the world. So sometimes it was publishers, sometimes it was direct lenders, and they were selling the clicks at I think reasonable rates. But people in the industry would ask me and would ask others, why doesn't Google just put an ad up for these cards and take the whole bounty? Because when someone applies for these cards and gets approved, forget $30 bucks, it's like $400, $500 for some of these high end like small business cards. It could be $1,000. So some people viewed it as Google being maybe short sighted or leaving money on the table in this particular category. So then they started actually showing direct listings. So the same way you see like Google shopping ads when you search for handbags or whatever, you will see like the Google shopping products. They were doing the same thing with credit cards, and it just never turned into anything. Consumers were much happier clicking on Chase or on NerdWallet or on Credit Karma than on the Google links. And part of it could have been, did they trust Google for that recommendation? That could have been the gap. The other possibility is that they viewed all the Google, like the native Google stuff, as bought. Like it was obviously paid advertising, and Google couldn't possibly have your best interests at heart. So I think there's two sides of the coin there on like exactly why people didn't gravitate to it. But I think Google eventually shut it down. I haven't seen like a native Google listing for credit cards in a long time. But I remember everyone in the industry being paranoid that just Google was going to eat everything and that all these publishers were going to go out of business. And that just never happened. Even though they had the scale and the resources and all, they probably had everyone out resourced by 100x. and it just the consumer didn't gravitate towards it. So in this context, like OpenAI, um, would I take OpenAI's recommendation on a credit card? Me personally, if I thought they had unfair information advantage to Google or Karma or to somebody else, me personally, I do think I would buy into a recommendation from OpenAI. But if they told me, "Hey, go all the way through, give me your SSN, give me the login to your bank, and let me just actually go make this happen like agentically," I would have some heartburn about that personally. So I'm somewhere in between.
I want to push you on this because perhaps this time is different. So help me understand which gap is easier to close. Let's say you have a big publisher and they're trying to build world class AI or AI solutions built on top of a foundational model like OpenAI. Is that harder? Or if OpenAI just goes and they navigate all the regulatory compliance and complexity to earn that financial trust, like which is harder today, do you think?
Yeah, tough question. Tough
I
question.
know. That's why they pay you the big bucks. That's
Yeah,
why
I'm gonna
yeah.
log.
Yeah.
I'm going to history here, but I mean, I'll give you an example where I was actually surprised it worked. Like let's take Robinhood. I think it's a really good example. Robinhood came to market, no name, no brand. It's obviously very well recognized today, but when they got going, they just had a very unique value prop. We're going to stop charging you these $7 per trade that E-Trade and Schwab and Fidelity, everyone's like gouging you these 20. Sometimes it was 20. I remember brokerages were charging me $20 per trade. And Robinhood just showed up and said, fuck that, it's free. Straight up. And they had no brand, no credibility, no trust, and the value prop was so good that people were willing to overlook it and work with this unknown brand to trade stock. Although it wasn't my dad. It wasn't that segment. It wasn't the established segment. It was like 20-year-olds that were trading for the first time. So they attracted a particular audience, but it did work and they ended up building a brand for themselves. So I could see the value prop here with OpenAI being so compelling that people are willing to say, hey, you're not Chase, you're not Credit Karma, you're not NerdWallet, but I'll still trust you because the thing you've built is just so kick-ass. I could see that as a possibility. However, a part of me just really doubts, or there's a good, like, you can probably sense like the doubt I have in that answer because I've seen Google try it. And as soon as you're trusting your checking account information to a third party, I do think that raises a different level of trust. Like, I think the bar is super high here. So if I were to give you kind of my hunch, I think the under 30 crowd probably swarms to something like this, and then like the older generation probably sits on the sidelines for a long time. That's my hunch.
Cool.
Yeah.
This has been great, Carlos.
Yeah.
I think we should continue this conversation in two ways. We don't have enough time, but I want a separate conversation. Like if we were builders in this, what would we build? And if any listener is interested in like just kind of riffing with us on that, like I would love to talk to them. But I would also like to extend this conversation further, right? And so this is the shameless plug for our affiliate marketing summit, September 23rd and 24th in San Francisco. So be sure to save those dates. I can easily imagine us having a panel or a deep conversation or a private dinner, just unpacking this question even further. If you're interested, go to our newsletter from yesterday. You can click on the ad. It sends an email to info@thefewtoaster.com, SF event. Just let us know you're interested and we'll do something for you and definitely keep you in the know.
Nick, good to see you, man. We'll talk next week.